So first of all, let's read the question. Mr. X purchased a put option for 300 shares of A, which means there were shares of A company. Mr. X purchased 300 shares of company A. The strike price is of 2000 rupees with a maturity of 2 months for a premium of 50 rupees, which means the strike price was rupees 2000 and the maturity is after 2 months, for which he has paid a premium of rupees 50 per share. And on maturity, the shares of company A, price rate of shares were 1900 rupees, and we need to calculate the profit or loss for the individual on transaction. So, before understanding all of this, let's understand what a put option is. Okay? So, now there are two types of options. One is a put option, which is basically used for a sale contract. And the second one that we have is a call option, which we generally use to buy a contract. Okay? Understand it like this. Now let's say we have a person named B. B, who wants to make a transaction and sell something in the future. Okay? But now B is afraid about its future. He is afraid that what if in the future the price goes down or goes up. Okay? So B wants the surety of good price for the shares. So basically what B will do, B will purchase a put option. A put option gives B the right to sell the shares if he wants. Since it's an option, it depends on the buyer here. It means who is the buyer? B is the buyer of the put option. So, as you see now, it depends upon B, the buyer. It totally depends on him whether he wants to sell the contract or not. Let's understand this with an example. Let's say B purchased a share worth 100 rupees. So in the future, if he purchase an option for this share's value, let's say he purchase a put option, and there is a price that is called strike price. The strike price is basically the minimum price that B will definitely get when he sells the shares no matter what. Let's say in the future, assume that the strike price is fixed at 110 rupees. Okay? And now assume that in the future, when this time comes, the share price, which was 100 rupees earlier, that same share price is now only 90 rupees. What? 90 rupees. This means the price has gone down. So here, the person B has a right. He has a right to sell based on which the shares are sold upon the agreed strike price of 110 rupees. Now, he won't care whether company is in loss or profit. He will sell the shares based on the strike price. Okay? On the other hand, if the share price doesn't go down to 90 and it becomes 150, in the future, the price of the share he purchased was rupees 150. So here, this one. This contract of put option. This contract is not an obligation here. Buyer is not bound to sell it at 110 rupees. Yes, buyer is not bound. So, the buyer will not sell it for 110. Instead, he will sell it for 150. Okay, so what is this? An option. It's basically an option for the buyer. Put option is for the buyer. In this example, we will talk about the put option. In the next video, we will talk about the call option. In that video, I will explain the call option in detail. Now come back to the question. What does the question say? The question tells us that the number of shares that were purchased. On behalf of Mr. X is talking about how many shares? 300 shares. Okay. And further, the strike price of the share is 2000 rupees. And this is for a 2-month contract. The put option here, for which the premium paid for each share is 50 rupees. 50 rupees. Okay. Question is saying that the price of the shares on maturity was rupees 1900. So after 2 months, the share price dropped from 2000 rupees to 1900 rupees per share. And since this is an option, let's assume that Mr. X sold the shares at the maturity date at maturity time at least for the strike price of 2000. Okay. Here, question doesn't tell about the price. The market price is lower, so X will sell the shares at the strike price of at least 2000 rupees. So the total price here will be 300 shares sold at a rate of 2000 rupees per share, which equals to 60,000. Because the market price is lower than the strike price, Mr. X will sell the shares at the strike price. So this is the selling of Mr. X. This means that Mr. X sold 300 shares at rupees 2000 each for a total of rupees 6 lakhs after 2 months. So what is the total value of the shares? Is it 60,000? No, it is rupees 6 lakhs. I am omitting a zero here. So here the total value is 6 lakh rupees, not 60,000. So the total value is 6 lakh rupees. Value of the shares is 6 lakh.